something we've talked about, but haven't really backed up sometimes with concrete data, is how many of us are now shifting the kinds of things we do online. We talk about it, but for instance, have you gone shopping? I bet you have. And who's benefiting from the increased online shopping, or are you planning a vacation? Let's break this down with Greg Malen, who is SimilarWeb's Vice President of Solutions. He's joining us now to talk about some of the data that they aggregate and then sell to their clients, and those clients use that data to invest. It's good to have you here.
Thanks for having me.
So, Greg, before we jump into this, were you folks surprised by some of the trends you saw? And we're going to talk specifically, for instance, about some private companies, Airbnb and VRBO, but we're also going to talk about publicly traded companies like Wayfair. But were there any big shocks to you?
I think what surprised us initially was the stability of some of the e-commerce kind of business that we saw. Obviously, we would expect a major drop-off in airlines and hotel accommodations. But what we were surprised to see was that there was a consistent need for sporting goods, for example, and the luxury good items have also recovered rather quickly. So in that sense, they have been very resilient to the dynamics of the market, and that kind of surprised us in our tracking.
All right, so let's jump into one of the graphics you actually prepared for us, and that's the vacation rental market, the share increase of 46% year over year in May 2020. And specifically, what are you seeing and what is it telling a potential investor who uses this data?
Yeah, so we were looking at data in a capacity of looking at things from a destination level. So we wanted to look at the states that were capturing the most amount of bookings over the past couple of months. And what we saw when we looked at in May was that overall the vacation rental share of the market was up 46%. This was taking away share from companies like Marriott and Hilton, as well as OTAs like Expedia and Booking.com. And overall, what we saw in this trend was not just that the vacation rental share was growing, but also that consumers had a higher propensity to do drivable destinations. So for those of us living in the New York City area, we were looking to go to the Hamptons or the Poconos. There's still that interest in doing your beach vacation like Myrtle Beach for the summer. However, we just saw that these drivable people did not want to get in onto planes and fly anywhere. So they were looking for destinations that were close by and away from people.
Greg, Jared Blicker here.
Go, Jared.
I was just going to ask about the retail front, because we've seen a number of retailers that really don't have their digital strategies in order really suffer at the hands of this coronavirus. Any surprises there? And do you see any increasing bifurcation between the haves and haves not?
Yeah, so it's a great question. I think what we always have to keep in mind when we look at our digital data and growth is that when you have a brick and mortar presence, that digital growth that we're seeing is not going to offset the loss of the brick and mortar shopper. So companies like Wayfair and Amazon, when you look at that growth, it's pure. But when you compare something even as simple as a Sephora or a Nike, which maintain brick and mortar locations, even though they've shown strong growth, I think I saw that Lululemon was showing 70% of direct-to-consumer growth yesterday. But ultimately, they're not going to be able to replace that brick and mortar kind of presence. I think that when we see the haves and the have-nots in terms of how well people are performing, we saw three buckets kind of emerge. We saw companies that cut their digital investment in terms of media spend almost immediately when COVID hit. We saw companies take a wait-and-see approach. These were companies that kind of wanted to straddle we're not really sure if it's going to be really bad or if it's going to recover in that V recovery. And then we saw companies double down. And those companies that double down, there were companies like Sephora and Wayfair that just saw tremendous growth, especially in April and May. And this was across industry. And so it was very impressive to see those companies do so well.
We have a chart you prepared, paid search fueling Wayfair's growth and the doubling of channel visits year over year. Specifically, what is Wayfair doing that others may not? I mean, it says it in the chart, but they're having to spend money to get the extra eyeballs, aren't they?
Yeah, so I presented in late February at a conference that it was just after Wayfair cut 3% of their employees, and they were really just losing out to Amazon. Amazon was kind of replacing them in terms of consumers being able to buy furniture products directly, on the site they do so many other things for. What Wayfair is now doing is they double down after these kind of paid terms and areas where Amazon actually retreated. Amazon in April announced that they were cutting their commission rates for their affiliate program from 8% to 3% for the home improvement area. Wayfair, you can see, is seeing an increase in that. And ultimately what we're seeing is that conversions were up, I think 92% in May for Wayfair year over year. So they're really, this is where they're focusing, where others have kind of given away some of that territory. They've stepped up and taken advantage.
You can find SimilarWeb at SimilarWeb.com. They give an investor an advantage with the data they aggregate. Greg, it was great to have you here. Greg Malen is the SimilarWeb Vice President of Solutions. All the best to you.
Thanks.